Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. If the markets were not listening to the Fed members pour cold water over their sharp rate cut expectations, they have been woken up with a rude awakening after the US CPI data. The data indicated inflation did not fall as sharply as markets had indicated, making the aggressive rate cut bets look less attractive. What immediately became less attractive were also equities, S&P 500 falling around 1.3% and Nasdaq around 1.5%. Good morning, JK. Your take on the market reaction yesterday. If I'm just looking at the numbers, it seems inflation has cooled, except the core. But how are you reading it?
Good morning, Swaraj. So markets took it pretty hard because it puts a nail in the coffin for an early rate cut. March was already, at a low probability of rate cut, and even the May cut has now come down below 50% probability. Another factor to observe is that markets positioning due to expectation of early and hefty rate cuts, and that also got a big jolt. Forget March, even May cut is now, less probable. And the extent of rate cuts in 2024 is less than 1% versus 1.5% that we had seen at the peak. And for the market that was super long on bonds, on the dovish view, it wasn't surprising to see the 2-year bond yield surge by 20 basis points, 10-year nearly 17 basis points, and 30-year by 8 basis points. And in the process, 10-year has also broken key resistance at 4.20 and seems headed to 4.5% unless we see a real bad news on the economy or a larger fall in the PCE inflation. Let's not forget that US Treasury is the worst position for the rise in the yields, as they have to manage an ever-increasing deficit and also borrowing at much higher rates. So the irony is that many people may be praying for a crisis that leads to an early rate cut. Now, on the numbers itself, the price index rose more than forecast, mainly on the monthly basis. The headline month on month coming at 0.4 versus 0.2 expected and previous, and core month on month was 0.4 versus 0.3 expected and previous. Core year on year fell less than expected, as well as the headline. So in the details, one can see that there were some portions that gave comfort, like used car prices were falling, and also some of the goods and services prices were actually falling. But the big rise was seen in the rentals, which is key to getting the inflation down to the targets, as per many economists. And of course, what may still keep the doors alive is the surprise jump in the January consumer price index will probably be less pronounced in the Fed's preferred inflation gauge, that is a PCE, which will be announced on 29th of February. So the stocks route that you would refer to is not at all surprising. Again, badly positioned. Evidence was a stunning 23% rally in the benchmark S&P 500 in less than 4 months. That had strayed too far away from what the fundamentals justified, and technically trading 13% above 200-day moving average, which rarely occurs. And every time it has happened, it was followed by a steep fall. So the outlook definitely is for more correction in stocks across the markets as they adjust their positions according to revised expectation on rates. Dollar index swung up 0.75% to near 105 after the data, as the yield difference with other currencies widened. The index is now well above 104.25 resistance level, around which it was hovering for quite some time, and now looks headed for 106. Of course, medium-term dollar is bearish, but I think we have to leave for some more corrective strength in the dollar. The single currency euro fell from 0.795 to 0.7 after the data, having got earlier supported due to stronger ZEW survey that rose for 4th month in a row. Losses were not as much as one would have expected because euro yields also rose, and some ECB members were again pushing back against expectation of early rate cut. Technically, having broken 1.0720, it can test 1.0650 next. Sterling was an even better performer as labor market data was strong, wages rising, unemployment rate lower, and new employment also beating expectations. Even though outlook on the UK economy is poor, even some officials hinting at a mild recession, we cannot see BOE cutting rates in the face of increased wages and potential push to inflation, much before the third quarter. Even though GBP fell after the data, it has stayed well above the month low of 1.2517. We have a lot more macro data from UK, GDP, industrial production, trade, inflation, and retail sales in the coming days. And these will have to be passed very closely. And if at all we break the support at 1.25, I think we can see a bigger slide in the GBP. Japanese and gross underperformer with compared to other major currencies falling 7.5% in this calendar year alone. And this is because of the widening yield difference between Japan as well as others. And more particularly after a statement from BOJ official earlier in the month who said they don't plan to raise rates more, even after giving up the negative rates. Yen continues to be used in carry trades and also helped Japanese stock index reaching near highs seen in 1989. CPI and higher yield in the US has given it a further push, but at the same time, we've already seen some rhetoric from one of the officials from Japan hinting at intervention and calling the recent rise in the USD yen as very rapid. So we can expect some sort of stalling in the USD yen rise as we move above 151. 152 has been a double top so far for the currency. And of course, gold broke the 2000 mark again because of the yields rising everywhere. And again, possibly market positioning itself for a new high in the gold. They have probably got stopped out as well. Now, in the offshore market, the rupee, rupee did have an uptick towards 83.18, although it stayed in one of the narrowest ranges yesterday during the day. The expectation of, or rather no expectation of early rate cut from US, and that can lead to some slowdown in the bond market flows in India as well because of, even our yields might rise. We think that the demand supply balance in Indian rupee might be slightly tilted to the upside, and we can be not surprised if we do test 83.20 in the coming days by the time USD index also reaches its interim objective. So, but we do have some more macro data ahead this week. WPI inflation today, which is expected to come at 0.53 versus 0.73% in December. We do watch WPI, not so important from a monetary policy perspective, but because it has a lag impact on the retail inflation. The other important possible bigger impact is from the monthly trade data, which should be out either tomorrow or day after. Deficit expected to stay near 20 billion like last month, and consistently staying at these levels augurs well for rupees stability. All in all, we are slightly in a dollar bullish environment, and risk assets are likely to take more correction in the coming days. Thank you.
Thank you, JK. And if I could quickly summarize, I think you said it well when you started. It's the nail in the coffin for an early rate cut. And even if you think about March, if we forget about the March rate cuts, even the May rate cut probabilities have gone down. So this year's cumulative rate cut expectation is now at 1% versus 1.5% at its peak. When it comes to inflation headline, inflation rose more than expected on a month-on-month basis. And of course, as JK mentioned in the details, used car prices, some goods and services had fallen, but rentals remain a laggard. And markets were not positioned correctly for this data, which led to a reaction. Yields rose, stock fell, and dollar strung up. And even gold broke the $2,000 support mark. For the rupee, we saw some weakening in the offshore market towards 83.18, but it does seem to be opening lower today. 83.20 is a good resistance. Key data for India to look out for would be the WPI inflation as well as the monthly trade data, which should be out soon. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.